Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Edmund Shing of BNP Paribas, one of Europe's premier investment banks. So welcome, Edmund.
Thank you, Paul.
Just given all the sort of the recent shenanigans in Westminster, and likewise, we've had some stuff out in China as well with their annual sort of conference. But also we've got continual rising inflation levels or high inflation levels, rising bond yields, the ongoing war in Ukraine. Just putting all that together, what's your sort of like your broad outlook for equities and bonds going forward? It's a pretty tough one to start with, but what do you reckon?
Not at all. I think, Paul, the starting point is, yes, things are bad, but then equally, investors are also incredibly pessimistic. If we look at all the sentiment surveys, they're pretty much at the lows. I mean, multi-year lows. There is some question about positioning, whether or not that is reflected in people's actual positioning. So yes, people may feel black, but are they positioned as defensively? But I would say, if you look at some of the latest statistics, that they are pretty negatively positioned as well. For instance, the numbers of calls and puts. If you look at the ratio of calls and puts, very much skewed in favor of puts right now in terms of options. That tells you people have been buying protection for their equity portfolios. Futures, similar. They're very negatively positioned to futures, again suggesting that at least institutional investors are also very negatively positioned and have been protecting their equity portfolios, expecting a further fall. So that is where we are. Bond yields, as you mentioned as well. Bonds have had a terrible time, surprisingly, because normally when equities suffer, bonds go up. Not this year. This year is the exception, where because of high inflation, we have seen bonds suffer pretty much almost as much as equities, particularly if you're invested in gilts, for instance. Our wonderful UK sovereign bonds have not had a happy time of it. But I think the point is, after suffering that much, the good news is that I think for a long-term patient investor, there are some interesting opportunities today for the long term, even if we cannot be sure about the timing today. Is it today the best time to go in? Is it in a month's time? Is it in a week's time? Don't know. No one ever knows. You can never call the bottom market. We all know that. But for a patient long-term investor, today represents, I think, a very good opportunity, because we do see stocks very cheaply valued. Easy to say. But you know what, Paul? Recessions come and go. And after recession, you get growth again. So at some point, growth will come back. Whether it's next year, the year after, it will come back. And the cycle begins again. And so getting in now when valuations are cheap, when everyone's pessimistic, has proven in the past to be a fairly good strategy for the long-term investor, even if in the short term, you know, we may go on a bit of a random walk, and certainly with volatility in the markets as it is, you know, anything can happen in the short term. But anything good as well as bad, in my view. I think we're almost at that point where less bad news will be interpreted by the markets as good news, and therefore will allow markets to rise.
Yeah, no, I'm with you. I like a good sort of contrarian play. But before we sort of dig into the details of sort of stocks and stuff, what's been sort of driving the real yields on the sort of 10-year treasury? Because yes, we've had inflation going up from sort of like, you know, it's been up and down the break-even inflation rates, and interest rates have gone up. But the real yield, sort of the TIPS 10-year, is now at about 1.7. And that's the highest since really 2008. So there's more than just rising inflation hitting that, you know, that bringing that up. Is the quantitative tightening draining liquidity also pushing that up, or what do you reckon?
Well, I think it's a combination of several things. That may be part of it, but I would start from the beginning, which is to say that since 2008, I would rather say that we've been in as we all know, a very unusual period of negative or zero interest rates, and at the long end, it has been. Remember, bond yields did go negative in a number of markets for quite some period of time. Remember, we were talking about the stock of negative interest rate sovereign bonds rising and rising and rising for many years. So that was an unusual context, and I would say that was abnormal. So we've corrected one abnormality in that these very negative yields have gone back to positive territory. Because let's not forget, in the very long term, Paul, real yields should reflect, or should be around, somewhere around the level of trend growth in real terms. So it's not normal that it was negative over the long period. It should have been positive. Okay, maybe it's shot a bit too far in the opposite direction. As you know, markets being what markets are, and this is George Soros's notion of reflexivity, you never go from being undervalued or overvalued back to fair value and stop. You tend to go straight through fair value and keep on going. Maybe that's exactly what's happened. We've overshot. Maybe real yields are a little bit too tight, reflecting, I think, the volatility in the economy or the uncertainty, number one. Number two, not only the uncertainty around growth, but more importantly around the inflation outlook. Because we'd taken it for granted for many, many years that inflation was gone and dead. And I remember books were written saying inflation is dead. When you see things like that, it's like the magazine covers. You think, oh God,
yeah,
the opposite is about to, you're tempting fate. The opposite is about to happen. And voila, that's what we've had. But I think it is all of that. And I think you're right. An additional element is certainly the way that the Federal Reserve in the US is trying to drain liquidity by shrinking their balance sheet, by selling some of the bonds in their balance sheet, which obviously puts pressure because, if you think about supply and demand, suddenly there's a lot more supply. And don't forget, Paul, it's not just the quantitative tightening, but it's also all of this deficit spending that governments have been doing everywhere in the world post-COVID. I think they were right to do it, but let's not forget that has built up the stock of debt, which then needs to be rolled over, which means the supply of these government bonds is greater today than it would have been in previous years. And at some point, investors say, okay, that's all very well, but you're going to try to thrust this huge supply of bonds at me. I'm going to require a higher interest rate, a higher return to accept that. That's
so you've basically got more supply and you've got the government draining some stuff. So you've got the worst of both worlds.
Yeah, exactly.
So just on that, I mean, it's been the sort of the macro forces that have been driving certainly most of the equity markets. What's your sort of latest view of when US interest rates are going to top out and at what level? Because I think looking at the sort of the swaps market, the US sort of like, Fed funds rate, it seems to be peaking. The market reckon it's about 5%.
Yeah, I would say in terms of the rate, 4.75 to 5% smells about right to me, because that is if we sort of go back and say, what is a neutral rate of interest where the Fed is neither helping the economy nor slowing it down? You would say that might be 4 and a bit percent. Let's say around 4 and a bit. So by the time you get to 4.75, you're clearly in what we call restrictive territory. You're clearly at the point where the Federal Reserve is applying the brakes to the economy. So 4.75 to 5 smells about right to me. Do they need to go higher than that? I don't think so, because it's quite clear to me, at least, that the US is slowing down. It is quite clear to me that the inflationary forces, in particular, are slowing down around the world. So we can isolate these into three in the US. Firstly, we have, of course, the aftermath of COVID. So we have all of the supply chain disruptions, which have, of course, temporarily restricted goods, the goods exports from Asia to Europe and the US. That is reversing. That's finished. But it's still in the inflation numbers, but it's going to fade away pretty quickly over the next few months because we know that was a last year issue. Secondly, you have energy costs, which are probably much more a problem in the UK and Europe than in the US, because the US is a big commodity producer. They produce a lot of oil and gas themselves, so they have less of that problem. But there's still an inflation influence because natural gas prices and oil prices in the US are still higher than they were a year ago. Again, that's there, but it's fading. Then you have the third element, which I think is maybe the most troublesome element for the Fed, which is, of course, wage cost. This is what we call the wage inflation spiral, which is that inflation goes up, everyone says, oh, my cost of living's gone up. I go to my employer and say, hey, give us some more money. I can't live like this. Doesn't work at BNP Paribas, by the way. I tried that. But that at least is a theory. And then, of course, employers say, okay, we need to pay you more. Here's some more money. But then they jack up the prices, which push up inflation. Then you go round and round. That's a sort of 1970 style wage inflation spiral. There is a hint of that at the moment, because wages are going up rapidly. Unemployment is at pretty much near record lows in the US right now. That's what the Fed's most worried about, because that's the bit that can persist, can cause long-term structural inflation, and can be a very difficult beast to slay. But
so just on that, so if we've got the first two, which are sort of like, sort of be self-balancing, subject to obviously an escalation in Ukraine, with the second one with the energy. In terms of wages and labour, I mean, you are starting to already see some softness in the labour force. I mean, I looked at the last sort of like non-farm payrolls report, and it seemed as though there were a lot of employers were taking on part-time labour, and there was a reduction in hours per week work. So which says to me that people are holding on to their employees, but because they don't want to lose them, having gone through the COVID. But frankly, you know, in terms of because of the destocking and the reducing some of the supply chain surpluses in the market, that most of the manufacturers are actually sort of like not requiring as much labor, and therefore that's going to have a deflationary effect on the tightness. Absolutely, Paul. Although I would make one point, which is that the US economy, a bit like the UK economy, is predominantly service-based rather than manufacturing. So manufacturing is about 15% of the US economy. So that's not the swing factor. It's services. But I would absolutely agree with your point that there is slowing. You know, if you look at the Challenger grade data, which looks at corporate layoff announcements, they've spiked, as you would expect. The economy is slowing. Companies are saying, we're getting pressure on profit margins, costs are going up. Maybe we need to either freeze hiring or even lay off some people. That's starting to happen. That will have a delay. It's having an effect on the employment market. It takes time to work its way through, but it's definitely happening. And as the economy slows further, because the Fed has raised rates, remember, why has the Fed raised rates? Why does any central bank raise rates? It's to kill inflation. But how does that work? It works by killing growth first, unfortunately, by killing demand in the economy. You kill demand in the economy by making the cost of money more expensive to borrow, and then in turn, prices should slow down. That's the theory. So, of course, that middle part of you're going to kill demand also means you're going to hurt employment. That is exactly, you could almost argue that is exactly explicitly the central bank's intention, in the Fed's intention in this case, and I think it is going to work. You're seeing, as you said, the first signs of that. I think you're right, it will accelerate. And I think these disinflationary tendencies across the US economy will, in fact, accelerate over the next few months. And that is exactly why the Fed may well go on pause as soon as December of this year or January next year, to see, you know, like it's almost like we put the brakes on. Let's see what effect that has before we go and put the brakes on even more. Maybe we don't need to. Yeah, in terms of the sort of the Fed, I mean, it's not only put the brakes on and hit demand, destroyed demand, it's destroyed the stock market, the bond market, as we know. And sort of coming full circle then, in terms of the sort of the better times, and we've had a couple of decent days on. I mean, it's very early, could be just a bear market rally on the S&P 500. But if you're right, and we start seeing that third leg, the labour tightness sort of like cooling a bit, sort of early next year. Does that mean we're going, likely we could well get a rally in stocks simply because, they've seen the top, that uncertainty, that tail risk of getting to over 5% and 6%, I've heard people occasionally say, in terms of Fed funds rate for longer. And in terms of that tail risk has gone. And then obviously we should hopefully get a weakening in the dollar as well. Will that sort of potentially trigger a sort of like a bounce or a recovery in stocks and shares? I think so. I think there's a good chance of that. However, one has to be careful, Paul. I think the caveat I would also mention is that, again, with the raising of rates, the Fed usually breaks something, and if what it breaks is economic growth, and we have a recession more than a very modest recession in the US, then earnings will really suffer. If earnings really suffer, that might be the thing that puts the kibosh on any rally. But I agree with you. I think so. Let's go back. Let's say the Fed does flatten rates out. Does say, okay, we've hit 5% or 4.75, whatever it is, by December or January. We stop there for the time being. Maybe that's the peak. If that's the peak, generally bond yields will have already peaked 1 or 2 months before that, i.e. either now or next month. Okay. When bond yields peak and start going down, as maybe they're about to, real yields go down. When real yields go down, then the stock market can rally. Because again, that is the relationship between the bond market, one of the relationships at least. There are two things you have to bear in mind. Where are real yields going? If they're going down, good news for risk assets like stocks. Second thing, however, is of course the earnings aspect. If we're going to get a deep recession, earnings get hit hard. If we get a very mild recession, earnings get hit a lot less hard, and then we can maybe look through that to beyond where we get growth again. That's the only caveat I would place on the recovery rally. But I do think we're, given the very pessimistic point we're at, given that most of the bad news is already integrated, I think at this point, unless the recession is worse than we think in Europe and the US,
then I think a chance of a recovery rally is actually pretty good.
So just on that other one then, in terms of if we've we've got a best view of where sort of like, you know, bond yields are going to peak and when they're going to potentially improve, say early next year, etc. In terms of that earnings picture, if that's right on the sort of the macro side, where do you see sort of S&P 500 earnings? Because I mean, the market is obviously from the bottom up analyst has started off at the year about 250 for next year. Now it seems to be migrating to a base case. Well, it's 238 at the moment, but people are talking about 220 for next year. And so what's your latest view for that?
I mean, I don't put a specific figure in it, but to me, somewhere between 225, 230 sounds about, again, in the event of a mild or modest recession, sounds about the right level, to be honest with you.
And what would be then for 2024? I mean, if you do 16 times, if you did sort of 250 in 2024, 16 times, you get to 4,000. Yeah, which would seem still quite a sort of, that would be just bare. That would just assume that we get back to where we thought we'd be for, 2 years earlier.
I mean, yes, but I think we could do somewhat better than that, because I think we underestimate the power of earnings in certain sectors like energy. So again, as you know, energy is one of my preferred sectors. And remember that even though energy is not a big sector in terms of market cap terms at the moment, despite its good rally, it's a much bigger factor in terms of earnings contribution, because of course it has a very low PE, which means that the earnings contribution is much bigger in the index than its actual market cap weighting. And that's true in the UK as well, of course, by the way. So if earnings do well for energy companies, which I think they will do, oil and gas prices should stay high, in my view, sustainably over the medium term, then actually that could be quite a good support for the for earnings at the aggregate level. Secondly, I would say particularly in the US, if the dollar reverses and gets weaker, actually that's going to be really good, because it's been, at the moment, it's proving to be quite a big headwind for US earnings. One of the main reasons that earnings are being revised down for future quarters is exactly the delayed impact of the strong dollar on companies and sectors which have a lot of overseas earnings. And remember, Paul, that does not necessarily hurt the companies fundamentally. It's just a translation effect, which means they earn the money in Europe or in Asia, and then they bring it back in dollars to the US. Now, the level of the dollar doesn't actually matter for its competitive levels, because let's say you're a computer company making stuff in Asia, selling stuff in Asia, but you happen to be Google. Okay, you're making your money in Asia and you bring it back in dollars, but the level of the dollar doesn't affect how competitive you are versus other companies. So, it's almost like, it's just a translation effect, which is cosmetic in nature. It swings and roundabouts. It's bad now, it drags down earnings now, doesn't really change the nature of the company earnings power, which means if the dollar weakens, they rebound. Simple as that.
Yeah, it kills, say, UK consumers who want to go abroad for holiday or buy petrol for your car, that's for sure.
Yes, exactly. But on the other hand, for a UK exporting company, particularly one exporting to a US dollar-based economy like Asia, like the US, it should be fantastic, because their level of competitivity has just gone through the roof. Yeah, at least in currency terms.
Yeah, well, we don't do too much of that, unfortunately, but you're right. It should in theory.
There's always companies like Diageo that still make Scotch whiskey, can only be made in Scotland.
Okay. Well, let's start with those then. Let's start with some luxury ones, because I know you quite like. You've got Pernod Ricard, which is obviously does whiskey. I think it's just James's whiskey out in the States. Obviously, it does the cognacs as well. Exactly. Premium, drink spirits brand, and I think it's trading at roughly around about, not surprisingly, about 18 times next year's earnings.
It's not cheap, but then, of course, what you do get with that is a lot of visibility. Secondly, you get a lot of defensive qualities. I mean, to be blunt, even when people are depressed, if anything, they drink more alcohol, not less. So, I shouldn't say that. That's not a very PC thing to say, but it's true. Yeah, it's a bit counter-cyclical in that sense.
Yeah, it makes you, and you drink at home, don't you? And,
you stare at the bottom of the bottle and then get another one out.
Yeah. I guess the only thing would say is what happens if the premiumization trend sort of decelerates, because people have been trading up to good quality wines.
I think it depends what you're talking about, Paul. I think if you're a Heineken, for instance, I'm just picking a name at random, or an Interbrew, where you are specifically targeting premiumization from retail to mass affluent, trying to get up, then you may be at risk, because the problem is exactly those mass affluent the sort of middle class segment, which may come most under pressure from falling house prices, rising mortgage costs, rising energy costs. They may be squeezed. But if you're talking about the high end, I'm sorry, the rich are rich. And they're not really going to change their spending habits because of a bit more energy costs or higher mortgage costs, because these people are typically immune to that because they've got enough money already. So if you're talking about people who buy XO brandy, I'm sorry, they're probably going to continue to buy XO brandy come what may.
Yeah.
And so I think that's the difference between the luxury and the mass affluent segment, which would be, I think, which might come under pressure, and the true luxury, which is actually above that.
What about, because I quite like Kering, which is obviously Gucci,
same
and
argument,
Yves Saint Laurent, but that does service a more sort of like younger demographic than your sort of like your old and crusties like me and you.
Yeah, you're right. But then you could look at it the other way, Paul, which is that if young people can't buy a house because it's too expensive, and this is what we see in Japan, what do? They stay at home with their parents longer. Not good for us parents, but they have more spending power, and they end up buying more belts, more jewelry, more watches, and more handbags as a result. And that's why each working age young woman in Japan tends to have 3 or 4 fancy handbags because they're still living with their parents. They're not spending so much on rent, but that means they can spend on the fancy handbags instead. So
yeah, I mean, and also I'd point to investors, actually, it only trades at about 13, 14 times
exactly.
PE, so it's actually good value.
Yeah, and also let's not forget the travel segment, which was smashed over COVID and the lockdowns, is coming back like a train. This summer obviously has been very good for trading. You saw that with Louis Vuitton LVMH, for instance, that they traded super well. My guess is as well that even in going in next year over the summer season, you could see the same thing, another strong travel season.
Yeah. Okay, well, let's move into sort of the energy, one of your preferred areas, because you've got a lovely selection here of sort of like you've got your producers, you've got your integrated oils, and you've got a couple of refiners. Let's start off with a relatively higher beta play, sort of like in natural gas, EQT, which is a Permian Basin sort of like shale producer of largely natural gas out in the States.
So what I really like about North American producers is that
they're low cost.
Yeah, well, that's the point. They are pretty low cost. And what I like about them at the moment, I mean, you could talk about US shale or Canadian oil producers similarly, but if we take the US ones first, what I like about US shale at the moment is they're being very disciplined, which is exactly the opposite to what they were doing in 2015 when we had the first shale revolution. They were just they went on a debt-fueled investment binge. They just spent money like water to just develop as fast as possible without thought of the consequences in terms of margins. And, a lot of those companies ultimately went bankrupt and then have come out of, or rather Chapter 11, which is, this sort of protection from bankruptcy. They have then emerged since then as oil prices have recovered, but the collapse in oil prices really, really killed that segment. This time around, the survivors, which are the ones we look at today in the US shale basin, particularly in the Eagle Ford, Marcellus, Permian, are all much more disciplined with their investment. So actually, if you look at, for instance, the Baker Hughes rig count, how many new rigs people are using to drill holes for new wells, it's actually not going up very much. It's actually pretty low still, even at this point, even with oil prices as high as they are. What does it tell you? They are conserving cash, they're conserving profit margins, they're focused on profitability, not chasing sales growth at any and growth in reserves at any cost. That's very important. Discipline. So we're seeing that capital discipline we didn't see 7 or 8 years ago. Canada, I think, is even better, by the way, because their tax status is more favorable. And I think they could still develop LNG. Remember, the US has already developed liquefied natural gas export. In fact, they export more to Europe, more gas to Europe today than is provided either by Qatar in LNG or Russia through pipelines. The US is a bigger supplier than both already today, and it's going to get bigger still. I think Canada is likely to join the party. So they're likely to, they don't actually sell any LNG to Europe at the moment, but they've got tons of gas. So I think they're going to develop the LNG terminals, sell, and I think that's an even better story. So Canada, in many ways, if you can buy exposure to it, is an even better story than the US. But North American shale, oil and gas, I think is a very good place to be right now.
Yeah, I think you've raised a really good point, because it's playing the arbitrage, isn't it? Because you've got sort of high, you haven't been able to move gas that easy across sort of like, continents in the past, because you've got to obviously compress it and put it into LNG. But once you've got those export terminals, then given European natural gas is so much more expensive than
you're talking
than
5
the US.
times at least. I mean, okay, the price is changing daily, but the average up until recently has been at least a multiple of 5 times between Henry Hub in the US and the sort of Dutch TTF benchmark. So it's
the swing factors. It's effectively the US is likely to replace, and already has, the big swing of the Russian gas, isn't it?
Exactly,
so
exactly.
Should have a huge demand. Now, just to go into the integrated oils, TotalEnergies. Now, that's obviously one of the biggest and most successful integrated. Trading on, again, really reasonable sort of like, 6 times earnings, actually. Admittedly, because it is high earnings at the moment because it's been benefiting from a high oil price, but seems to be pretty much good value, actually, still.
Well, again, I mean, the outlook is that I think oil prices, the crude oil price, will stay sustainably high, because I think there's an asymmetry in prospect here, an asymmetry in the sense that OPEC Plus cannot make the price fall because they don't have any spare capacity left, to put it bluntly. In the past, they could have used spare capacity and they could have withdrawn more capacity to make prices rise, or they could add the spare capacity into the market to get prices to fall by flooding the market. They can't do that anymore. They can make prices rise by withdrawing capacity, but they don't have spare capacity to add because they haven't made the investment. And that's true for Russia, obviously. And also Russia has the whole sanctions issue, which is going to restrict export production anyway. But even in most other countries outside of Saudi and the UAE, they are producing at max already today. They can't go any faster. So,
and I guess if you get China coming back,
well, that's
at
the
point.
That's the point. If post-COVID we get some, even though they claim, Xi Jinping, the premier, has said we're going to maintain our zero COVID policy. It's a great success. It's not, by the way. But anyway, it's killing the economy. Excuse me.
Yes.
But in any case, if they do relax it behind the scenes, which is, I think, saying we maintain it, it's a great success. Obviously, politically speaking, he had to say that. Behind the scenes, we suspect that they're going to modify it, weaken it, and, for instance, give businessmen visas. They're going to progressively reopen next year. And as you said, oil demand from China will come back. And that's a big swing factor at a point when the market's already pretty tight. It's pretty balanced. If you get another 1 or 2 million, because you could have another 1 or 2 million barrels a day demand coming from China in the context of 100 million global demand, which is about 1 or 2%. But that 1 or 2% can make all the difference, can squeeze the price back above 100 on Brent, which obviously will be good for oil companies like Total. But Total is not just about that. It's also reinvesting heavily in renewable energies like BP and Shell. So there is that as well. But on top of that, there are the refining margins, which again, there is a tightness of refining capacity in Europe at the moment, because again, did you know, I'm sure you do, that we were up to now importing a lot of our diesel, so not just crude oil, but diesel, refined product, directly from Russia before the invasion. And now suddenly we can't anymore. So we need to find our refined diesel from somewhere else. You get a squeeze. And by the way, no one has built refineries for the last 20, 30 years in North America or Europe. So guess what? If you've got a refinery, it's suddenly become a lot more value. It used to hate it. Now it's suddenly a prized asset.
Yeah. And on that sort of refining margin, obviously you quite like Neste out in Scandinavia, which is a sort of like a biodiesel sort of like refiner, is it? I guess, is that the thesis, is it?
Yeah, that's exactly the thesis. It's green, so it's in the right space. Again, if you look at diesel, we're pushing more towards biodiesels, like you had E95, E98, where you get the ethanol added, and then it's you're adding more and more progressively as engines are adapted to be able to use more bio ingredient in the basic petrol. The same is happening with diesel as well. They're adding the biodiesel in, so you're getting more and more being added. So now with petrol, you're at E85, diesel, you're already at 10% biofuel within the diesel itself. And I think that's only going to increase over time. So, of course, for Neste, the combination of high refining margins of diesel generally, plus the extra demand for biofuel within the diesel, at the very least, is going to be an important driver. And let's be honest, Paul, we're going to be driving diesel and petrol cars for quite some time to come. It's not tomorrow that everyone's going to be driving an electric vehicle. That's the bottom line. Oil demand has only ever gone down globally, excuse me, during massive crises like COVID, because obviously, the economy came to a halt, and also 2008 global financial crisis. Pretty much all other years, global oil demand has gone up, not down, and that's even recently. despite all our investments in renewables, electric cars, blah blah blah. You know, the Western world, the world's desire for energy, it seems to be insatiable. And of course, even if we control our energy demand, the developing world is still growing. It's still, and when they grow, they take more energy. As they become a middle class, they consume more energy. So, you know, it's difficult to see that changing anytime.
It's amazing, isn't it, how things change? Because I can remember the 23rd of April 2020 when Brent hit
yes.
hit minus $32 per barrel. So,
well, you know, you said that
funny times.
It was, but you may well see the same thing for like next hour or even next day European gas prices soon, because storage is at nearly 100% across the UK and Europe. Number one, you still have these LNG cargoes arriving, and it's warm. So we're not got the heating on. So
apparently they're all stacked up in the Iberian.
Yeah, exactly.
They're all waiting to dock or something.
Well, this is it. So we may even get the sort of same absurdity in next hour or next day.
Well, I hope so, because we could do with putting our heating on.
Well, yeah, but you know, Paul, the positive spin on this is it could be really, you know, this could be a get out of jail free card for governments who, like the German or UK governments, who've committed to supporting households by capping energy prices, which is, you know, as we know, a massive bill. But that massive bill may come down if electricity and gas prices, remember, electricity prices are linked to gas prices. Yeah. So if the gas price comes down, the electricity price typically comes down. If they both come down, the size of that bill may diminish massively, which would be a huge benefit for the economy, for the government, and may actually help growth because it'll be less of a drag on growth going forwards.
That's a brilliant point. I mean, I've not heard that anywhere, but you're absolutely spot on. And I do pray you're right, because that'll put a big smile to everybody for Christmas.
Exactly. Yeah, everyone's so focused on the black swans and the bad news. That could be sort of the better news, as I said, could be one of those elements of less bad news, which is what we need to ignite a rally. Yeah.
So now just turn into sort of like all things sort of commodity related, but they've obviously got quite a good exposure into the EV metals. Is Glencore, which used to be just sort of coal, it's the old strata type of business, but they also do copper and nickel, which goes into the EV, you know, the batteries and into the wiring, etc. I mean, it's trading on about sort of 6 times earnings, again, ridiculously cheap.
Well, it's a cyclical, supposedly, but what I would say about the mining industry generally is it has consolidated, as we know, massively over the last 20 years. So whereas 20 years ago, they would kill each other by increasing production of whatever mineral once the price goes up to a certain level, well, they're not doing that anymore. They're being, again, much more disciplined about the capital investment. They have merged, and therefore you've formed like an oligopoly. And so if you look at production of copper or production of nickel or production of cobalt, you have oligopolies in each of these metals now for the production and refining. And Glencore is one of those big players, like Rio, like Anglo American. These are the big players globally, not just in Europe, obviously Australia and in South America, but they're globally controlling that. And what we need to remember, Paul, is if we believe in the energy transition, which I do, you should do, that means we can use a hell of a lot more copper, nickel, cobalt, whether it's, you know, solar panels, whether it's wind power, whether it's other form of renewable generation or investment in the infrastructure to be able to store the battery storage. We need industrial batteries so that when the wind doesn't blow, the sun doesn't shine, we still have electricity from renewables. You know, this is precisely why we've been relying on gas all of this time for peak load, because we don't have another solution. Well, the solution should be storing the electricity via big industrial battery solutions. For instance, electric cars, we've just talked about that. You know, whatever we say, that's going to continue to grow sharply because there is a political will as well as the economic rationale for it. And 4 times more copper is used in an electric vehicle compared to a petrol engine vehicle. So you know what's going to happen. And by the way, global copper stockpiles are at record lows because the demand is low in China at the moment. If the demand from China increases, that could unleash a real movement in the price of these metals. And by the way, nickel, Norris Nickel, under sanction, big producer of nickel as well as palladium in Russia, under sanction. We're looking for other suppliers. So there is a bit of a squeeze on globally. So I think the elements are there. Obviously, at the moment, the mining industry as a whole, Glencore as well, are being impacted by the sentiment, the negative sentiment around recession, which obviously means lower commodity demand in theory. But I would focus on that structural growth that we expect to see over the next 5-10 years look through the sort of current dip. And again, if China, for instance, eases the zero COVID policy, it may come sooner than we think.
Yeah, no, and it looks good sort of long-term value. It plays a good, excellent dividend. So along with the oil and gas
that's it.
guys.
You're paid to wait. That's the beauty of it.
You're paid very handsomely, no doubt about it. Now, just moving now to sort of energy efficiency and all things automation. Schneider Electric, who's a big sort of like French sort of like electric automation and sort of like business, etc. And they're buying, I think, or they're looking to buy Aviva in the UK. Correct. That's not the insurer. That's the build tech specialist software guys and stuff. Do you want to take us? Because it does seem to be a really high quality company, generating around about 20% EBITDA margins, trading at about 19 times, but really with real sort of competitive advantages and USPs.
Exactly. Again, they've been building an oligopoly in the area, particularly in the sphere of energy efficiency. So things like intelligent light controls, so that, how often have we walked around the city, Birmingham, London, and you see the lights on in the offices at night? You think, well, why the hell are the lights on when there's clearly nobody there? Yeah. Or in your shop fronts massively illuminated when, again, the shops are closed. What is the logic there? Well, again, companies like Schneider provide intelligent controls so that when there's no one in the room, the lights are automatically switched off. Yeah. It's so obvious. Or, for instance, intelligent heat sensors controls that can alter the thermostat intelligently relative to the ambient temperatures. So you can actually, but you can do that with the whole building, not just one thermostat centrally placed, but you can do it room by room so that you have a good ambient temperature without wasting your heating. So it's all about energy efficiency, because we know that investment in energy efficiency is typically 9 times more productive in saving energy than spending money on energy generation. It's better, it's much cheaper basically to conserve the energy in the first place than to spend money on generating more and more energy. That's the theory. And Schneider is at the forefront of that revolution. I think we're still in the early days. Okay, LED lighting, we've got it now. So we're doing that. Insulation, we're starting to do that. But we can go so much further. There are so many things we can do, like intelligent glass, which basically can darken when it's too hot, can lighten up, let more light in when it's too cold, stuff like that. And it's not much in it. Or you could even find, for instance, there is even glass where you can find very thin film solar panels, transparent ones, built in between the layers of glass, so that they also act as a solar panel. It's stuff like that. It's coming. And Schneider is part of that revolution, but more on the controls. And again, let's not forget that as time goes on, Paul, building regulations are becoming more eco-friendly. They're getting tougher and tougher in terms of insulation, in terms of all other ecological norms. That can only be good news for companies like Schneider, particularly in big buildings, because they specialize not in the sort of small residential stuff, but in the bigger buildings like offices, warehouses, and shopping centers. And there, the ecological norms are improving, just the environmental norms are improving, meaning there should be structural demand for their products.
Yeah, and I think adding Aviva will be a perfect fit, because you'll
get all that. Exactly why they want it.
Yeah, you'll get all that data, and you'll be able to take the whole system in place, so you can take it from sort of design stage to operate, and then super efficient operation afterwards, and on a life's building of maybe 75 years. So
exactly, it's because a lot of it will be retrofitting old. It's not going to be building just new build. It will be retrofitting the old buildings to fit the new to suit the new environmental standards.
Yeah. Now, moving on, another massive trend that you quite like is cybersecurity, with the granddaddy of the industry, Palo Alto, that I think is the number one in sort of like network, sort of like security, etc. And it still is reasonably expensive, but it's come down a long way. It's by about 50 times earnings, 7-8 times sales, etc., which is actually historically quite cheap for cybersecurity stocks.
Yeah, it's a difficult one because, as you say, growth stocks have been absolutely hammered in fact, since mid-21. Since mid-2021, they've all been hammered. Cybersecurity stocks with it. But let's look at the structural growth. The structural growth, I mean, the bad news is cyber attacks are not only on the increase, but they're increasing exponentially. And that is true for individuals like you and me. So we have to protect our phones, our computers. But it gets worse than that, because with the Internet of Things, you might have a connected fridge, a connected TV. These are weak spots for hackers to target when entering your network. That is not just true of our home networks, but of course, at an industrial scale for companies, it's true of company networks as well. And there, the number of attacks on companies, for instance, ransomware attacks, are just increasing exponentially. And insurers don't want to cover that risk. They'll say,
No.
if you don't take those measures, we ain't covering you. So it's going to be like, upgrade your door or window locks, or you aren't getting cheap insurance anymore. Well, it's going to be the same for companies. They're going to have to prove that they have taken every reasonable measure to protect themselves against cyber attack, all the various types of cyber attack, which are on this massive increase, and which costs companies a fortune, not only in the ransom, but more important in terms of the reputational risk, and also the risk of fines. You can get fined massively by regulators in Europe, in the US, wherever, if customer data is compromised or lost.
Yeah, and I did see actually a survey from CNBC. They went round all the houses on the CIOs in large corporates and asked them where they might be sort of like spending and saving next year. And there was only one area where they were increasing by a lot, and that was cybersecurity. And I think if you go, as you've rightly pointed, if you go to sort of the granddaddy, the sort of the best in class systems, etc., then if you're a CIO, nobody can complain that you've gone with your best system.
Well, exactly. It's like in the old days. No, you could never be sacked for buying IBM. Well,
yeah,
these days,
exactly.
As a chief information officer or a chief technology officer, you're not going to get fired for spending a lot on cybersecurity because it's such an obvious risk to the business.
Yeah, but you will do if you don't.
Yeah, exactly.
No, so it's job preservation as much, I think. Food security is another one. Now, Nutrien, which is obviously one of the world's biggest fertilizer stroke potash producers. I think it was part of, there's a big Canadian potash of the old former business, etc. Do you want to take us through that? Because again, it's sort of like trading at it's about 5 times earnings.
Yeah. Because the theory is they're at peak earnings because fertilizer prices have gone up. Why? Yeah. Because particularly nitrogen fertilizer prices are intimately linked to the cost of energy because they're the production is very energy intensive. So you can imagine in Europe that's been an absolute catastrophe, which is why companies like Yara, based in Norway, have had to cut back production because the gas prices got more expensive, making fertilizer not cost effective to produce.
And that comes back to your point that you were talking about earlier with the US natural gas producers, because it's an input into US fertilizer manufacturers like these guys.
Correct, exactly that. They have access to much cheaper natural gas than Europe does today. That's probably going to remain the case, which means there is a competitive advantage to fertilizer makers in Canada and US. Second point is that for potash in particular, these potassium-based fertilizers, up to now, Europe had been getting a lot of these fertilizers from Belarus, which is now under sanction. Therefore, you can't get it from Belarus. Therefore, you need to get it from somewhere else.
Wow.
And potash is not, it's not a chemical production. It's mined together with salt. So you either got the mine or you haven't got the mine. Yeah. And there aren't so many mines around. Yeah. There you go. So there are things like Carly and Salz, K+S in Germany, which has one very old mine. But as I said, Nutrien is the bigger player in Canada, one of the biggest in the world, got potash mines because Canada's pretty rich in that stuff. Yeah.
And what about sort of like all things sort of like, automation and industrialization? We've got Atlas Copco, which does sort of like, compressors and vacuum and air treatment systems as well as, which is obviously for decarbonisation. Yes.
Well,
and then
exactly.
just power tools and assembly product. It does sort of like a whole lot of sort of like, sort of like power tools and stuff like that.
Yeah, I mean, it's obviously it's a very high quality company, which should stay there first of all. I mean, Swedish companies like German companies in that space, industrial automation and machinery, typically are. They're typically up with the Japanese in terms of
27% EBITDA margins, which says everything.
Exactly, they do stuff that other people can't do as well. I mean, it's as simple as that. But I think if we come back to things like obviously anything green, the investment in renewable infrastructure, this is going to help them. If we think about water, this is going to help them in terms of improving water security, water supply, and most importantly, industrial automation. We talk about the end of globalization and the return to nearshoring, that is bringing production of goods and services closer to home because we can't rely on these fragile supply chains. We can't rely on stuff coming from Asia. Okay, fine. But if we're going to do that and bring production of goods and services, let's say back to Europe or the US, we're not going to employ the same number of people because the wages are simply too expensive. Even if you go to the cheapest place in Europe, like Eastern Europe or even Portugal, it's still going to be much more expensive than in Asia. So what are you going to do to make it more cost effective? You invest more in industrial automation, like the car makers. The only way car makers have been able to continue making cars is by automating their factories, reducing the need for labor, right? And that's what companies like Atlas Copco enable you to do.
Yeah,
basically.
and Schneider Electric will do that as well.
As
I think,
well,
won't they?
absolutely right.
You know, you're right. I mean, you want to become more productive
Mm.
and faster with what
Yeah.
your limited resources you have.
And in the long term, we have to go down that road because we have aging populations, just like they have in South Korea and Japan. And it's no coincidence that as the labor force shrinks, you have to rely more on automation because you simply don't have the bodies. You don't have the same number of bodies. So you have to go to automation. And that's exactly why the highest penetration of industrial robots in the world is found in South Korea and Japan.
The last one is quite an interesting one, actually. It's Geberit, which does basically sanitary systems and toilets and bathroom.
I love this company. It's
exactly.
That's an archetypal quality company. People say, "Who the hell is Geberit?" Well, look. You go into any hotel, look at any toilet with a hidden cistern, where the cistern's buried in the wall. It's sure as eggs are eggs. The system inside is Geberit.
Oh, right. Okay.
So, and they also, if you look at your posh stainless steel taps, the posh mixer taps, not the English ones where we have the hot and cold, but the ones where you can mix the hot and cold together in one, which is the continental way, not the old fashioned, try to figure out the hot and the cold to get something reasonable temperature coming at the end. That's typically Geberit as well. They're the leaders in that sort of stuff. And that sounds basic, but you know what? Look at their profit margins and it tells you clearly it's not basic. 24%
EBIT margins.
There
that's fabulous.
Because they have a better system than anyone else, and they're Swiss. You wouldn't buy it from Switzerland because you know it's going to be expensive. You wouldn't buy it unless you knew it was the best. They are the best in all that stuff.
Brilliant. Okay. Well, thanks very much, Edmund, for all that lovely selection of good sort of defensives and dividend paying and solid balance sheets and long-term secular growers. So that's great. Just in terms of any sort of sort of global macro risk to watch out from, and I know it's obviously difficult to say, but is there anything out there that you think is worth watching or keeping an eye on?
Well, I think there are several things. I think there are three things. Firstly, obviously Ukraine. There could be a black swan event. Who knows? I don't want to mention, tactical nuclear weapons, but we all know it's a small risk, but it's not a zero risk. So I think that's the first point. And by the way, when it comes to Ukraine, people say, let's hope that there's a palace coup and then Putin is deposed. You have no idea. The replacement could be even worse. So be careful what you wish for. So that's one risk that's just unquantifiable, but it's there. Secondly, I would say liquidity. There could be, we've seen what happened on the UK. And the Bank of England was forced to step in. And it's pretty arcane what happened because, when you look at it, defined benefit pension funds are actually in very good health, according to statistics. However, there was this issue with these margin calls on the leveraged positions that they had on bonds. Okay, and you had these historic movements in bonds, which went the wrong way for them. So you get these liquidity issues that can come out of nowhere. And I think it's even possible to see something akin to that in the US. You could see a liquidity issue. Liquidity in the biggest market in the world, which is the US Treasury bond market, is poor compared with historic standards. So you never know. The fact that the Federal Reserve is trying to sell bonds into a market, the US Treasury is trying to issue a lot of bonds into a market where liquidity is low, could lead to liquidity problems. So that could be a reason for the Fed to change course pretty quickly, because let's not forget, for central banks, they have two mandates. One, get inflation back down near to 2%. Second, though, ensure financial stability in markets and in the economy. So that's the second one that the Bank of England had to invoke. Who knows? Maybe the Fed will have to do something similar at some point. That's a risk. So those are two things. Thirdly, of course, in Europe specifically, the energy prices. If we suddenly have a very cold snap and energy prices shoot up, that's going to put a lot more pressure on the economy. I mean, I'm hoping we get the opposite, that energy prices come down faster than we expect and stay lower for longer than we expect, which will be a good thing for the economy. But the reverse is also possible at some point over the winter. We have to remember the risks are still fairly high in the short term, at least.
And was it a sort of like precipitous collapse in the yen sort of like worry the markets, or would that just be so local that people are not too bothered about it?
Yeah, I mean, it would worry people in as far as it suggests that the strong dollar phase is not over. Again, if you want a sustained rally in like credit, equities, and so on, you would prefer the dollar to be stable to weaker. Yeah, it's unlikely that we can see a sustained stock market rally in the face of an ever stronger dollar, to be honest.
Brilliant. Okay, well, thanks very much, Edmund. And if anybody wants to sort of like, sort of put any money into sort of like some of the funds that BNP operate, how best to do that, or is it sort of like just look at the website?
Yeah, it's look at the website. We have a website. I would say if you want to find more information about what we talk about, what we do in wealth management, which is the private banking arm of BNP, they can look on, if they go onto Google and just search for BNP Paribas Wealth or Voice BNP, Voice of Wealth, they should fall onto our pages where we talk about investment strategy, the ideas, the themes, and so on.
Yeah. And I would highlight to investors, I read Edmund's strategy every month. So he puts a document, which is absolutely fab. It really is truly fabulous.
And, I'm on Twitter, I'm on LinkedIn. Yeah. So the other option is to try to find me there. We have videos, we have podcasts. We have a weekly podcast, for instance. So listening to that. We have monthly videos, as you've just pointed out, as well as the written reports.
Brilliant. Okay. Well, thanks very much, Edmund, and speak to you next year.
Thank you very much, Paul.
Bye.
Bye-bye.